Welcome to vTalkInsight, Market Drivers Daily for April 9th, 2026. Fragile ceasefire headlines in the Middle East are colliding with a stubborn oil risk premium and a roaring AI Capex cycle, leaving equities stuck between inflation risk and growth optimism. Let's unpack how today's energy shock, policy signals, and AI investment wave are shaping cross-asset pricing. The core macro story is that the ceasefire relief rally is fading, while the energy shock has not gone away. The Strait of Hormuz remains effectively choked. Oil is trading with a heavy risk premium, and that combination is capping near-term upside for equities even as longer-term growth views stay broadly constructive. Despite ceasefire headlines, shipping through the Strait of Hormuz is still severely restricted, with only a handful of vessels exiting against an estimated backlog of around 800 ships. Iran continues to assert control, floating ideas such as transit fees and mandatory coordination, while concerns about mines keep shipowners cautious. That bottleneck is tying up as much as 13 million barrels per day of crude, on top of lost regional production, and physical oil prices have surged toward $125 per barrel even as futures hover closer to 90. Oil price scenarios are unusually wide. Some major forecasters warn that if Hormuz stays impaired for another month, Brent could average around $100 through 2026, with each additional month of disruption potentially adding $15 to $20 as inventories run down. At the same time, markets are still pricing an eventual normalization, with long-dated futures implying lower prices by year-end and many participants assuming an interim deal that decouples Iran's nuclear file from regional oil exports. This energy backdrop is feeding directly into inflation and rates. Persistent oil near or above $100, combined with higher gas and fertilizer prices, is expected to keep headline inflation above 3% in the United States and to push nominal GDP higher, supporting upward pressure on yields. Recent Fed minutes highlight that some officials are open to further rate hikes if energy-driven inflation proves sticky, and bond markets have reacted with higher long-term yields rather than the classic flight to safety, reflecting concerns about both inflation and fiscal sustainability. Equity markets are showing resilience, but with clear fault lines. The S&P 500 sits only about 2.5% below its all-time high, helped by strong AI-linked earnings, yet several signals point to limited near-term upside. Recent gains were driven by the largest hedge fund short covering in over 4 years, and risk appetite is now pausing into a tense geopolitical weekend. Energy and utilities are outperforming in Europe, while travel, leisure, and airline stocks, which had rallied on earlier ceasefire optimism, are retreating as crude approaches $100 and carriers like Delta budget billions more for fuel. In foreign exchange, safe haven dynamics look different from past crises. The U.S. dollar's haven bid is relatively muted. The Swiss franc is seeing more pronounced inflows, and the yen remains weak as high energy costs keep dollar-yen elevated near the 159 to 160 area. Europe faces an additional squeeze. Governments have far less fiscal space than in earlier shocks to shield households from high energy prices, and increased defense spending commitments are pushing up bond yields in fiscally fragile countries such as Italy. There is a clear clash between bullish and bearish narratives. On one side, markets may be underestimating the risk of a prolonged Middle East conflict and the possibility that Brent stays near or above $100 for years, which would erode margins and raise recession risk, especially if prices move toward 120. On the other side, shipping executives and some traders expect flows through Hormuz to normalize within weeks under intense international pressure, including from China, and argue that Iran's leverage will diminish as alternative routes develop, supporting the view that today's war premium is temporary. For now, the practical message is that geopolitics remains the dominant macro driver and is keeping equities in a choppy, range-bound regime. Key signals to watch are tanker movements, especially Chinese vessels and ships carrying Iraqi and Saudi crude, the spread between physical benchmarks like dated Brent and futures, and any shift in central bank language around energy and inflation. Those dynamics are also feeding directly into the cost structure and valuations of one of the few clear structural growth stories in this market: artificial intelligence. The AI theme is moving into a more complex phase where genuine structural growth coexists with rising input costs, intense competition, and growing scrutiny of business models. Capital commitments remain enormous, but equity markets are starting to differentiate sharply between cash-generative platforms and capital-hungry model developers. On the growth side, AI infrastructure demand is extraordinary. Industry-wide cloud and data center commitments linked to AI are now estimated well above $1.5 trillion, with hyperscalers and specialist providers still capacity constrained despite heavy Capex. Meta has expanded its computing supply deal with CoreWeave to around $21 billion through 2032, and similar multi-year contracts are supporting analyst upgrades for optical chip makers, where certain segments are expected to grow as much as 90%. The model race itself remains fiercely competitive. Anthropic is seen as having a slight edge in current capabilities and is raising prices, while OpenAI is cutting prices to boost usage, suggesting its lead is less secure. Meta has launched a proprietary model and is shifting away from fully open source, aiming to deepen its moat, and European software vendors are under pressure as new models from Anthropic and Meta intensify competition and threaten traditional SaaS growth assumptions. At the same time, there are growing concerns about the quality and sustainability of AI spending. AI spend has jumped roughly 13-fold over the past year, growing at about 50% per quarter, but token usage is often used as a performance metric for engineers, which can inflate demand signals. Some infrastructure providers are responding differently. Anthropic is deliberately limiting usage and charging for access to gauge genuine demand, while OpenAI is cutting costs to drive volume, and frontier model share of tokens has fallen from over 20% to roughly 4% as users shift toward cheaper or more specialized models, including from China. Higher energy and materials costs are also biting. Rising electricity prices, more expensive memory and shipping, and local backlash against power-hungry data centers are squeezing margins for data center operators and cloud providers, with some stocks selling off despite strong revenue reports. Regulatory risk is building, particularly in Europe, where authorities are working to align the AI Act with existing data privacy rules and to shore up cybersecurity amid geopolitical tensions, adding compliance complexity for cross-border data and model deployments. For corporates, adoption is increasingly K-shaped. Data from tens of thousands of firms show that businesses effectively integrating AI have delivered revenue growth above 100% over 3 years, versus around 12% for low adopters. New tools are emerging to help CFOs track token usage and tie AI spend to measurable return on investment. And the conversation is shifting from maximizing usage to maximizing efficiency, even as declining unit costs risk triggering Jevon-style effects, where lower prices drive higher total consumption. In public markets, this all translates into greater dispersion and higher idiosyncratic risk. Investors are increasingly distinguishing between AI stories backed by strong organic cash flow, such as some large platforms, and those relying on repeated external funding, including model labs projected to burn hundreds of billions of dollars over the next several years. AI-related equities have underperformed at times despite headline growth, and lenders in private credit are becoming more selective with software exposure, reflecting concerns about disruption risk and recovery values. Stepping back, AI remains a key reason why U.S. equities have been relatively resilient to the energy shock, as AI-linked sectors now account for a substantial share of S&P earnings power. However, the energy intensity of AI infrastructure means that higher oil and power prices could initially make technology more inflationary than deflationary, especially if data center margins are squeezed and costs are passed on. Watch for upcoming earnings from hyperscalers, chipmakers, and software vendors, especially disclosures on AI-related Capex, margins, and backlog. Those numbers will help clarify whether the current AI wave is a sustainable multi-year investment cycle or at risk of an overbuild that could unwind when capital becomes more expensive. All of this is happening against a backdrop of fragile logistics, where the same geopolitics driving oil higher is also reshaping how energy and goods move around the world. The third piece of today's puzzle is the supply chain angle. Even if oil futures eventually settle, the way energy and commodities are moving is changing, and that is embedding a more persistent cost shock into freight, food, and manufactured goods. The Strait of Hormuz remains the central choke point. Shipping through the corridor is still heavily restricted, with only 3 vessels reported departing recently and ongoing talk of Iranian tolls and mandatory military escorts, which the International Maritime Organization is pushing back against to avoid setting a precedent. There is no official confirmation of mines, but safety concerns mean ship owners and insurers are reluctant to resume normal traffic until international verification is complete, keeping a large volume of oil, gas, and fertilizer effectively stranded. This has created a striking disconnect between physical and paper markets. Physical benchmarks like Dubai and dated Brent show steep backwardation and large premiums, with some physical deliveries clearing above $124 per barrel, while futures remain much lower. Refining capacity losses of around 2 million barrels per day, combined with refinery run cuts in China that reduce export availability, are tightening product markets for diesel, jet fuel, and petrochemicals, amplifying the impact of disrupted crude flows. Trade flows are being rewired on the fly. Asian buyers, especially from Japan, have been aggressively sourcing crude from the Atlantic basin to offset Middle East shortfalls, tightening supply there and setting Europe up for potential shortages as its buying cycle ramps. Some Asian governments have already moved to curtail industrial demand to protect households, while China's subdued LNG demand and high storage levels have allowed it to re-export cargoes, temporarily easing pressure on European gas, but not resolving underlying vulnerabilities. These logistic stresses are feeding into broader inflation channels. Higher shipping rates, alongside increased costs for fertilizer, packaging, and transport, are likely to filter into grocery prices and core goods inflation over the next several months, consistent with expectations that headline inflation remains elevated unless oil falls back toward the low 70s. OECD has already revised global GDP growth for 2026 down by about 0.3 percentage points due to the conflict and energy shock, and countries with limited reserves, such as Indonesia and Thailand, look particularly exposed to sustained high import bills. Market pricing still leans toward a relatively swift normalization, with shipping companies expecting conditions in Hormuz to improve within weeks under strong international pressure, including from China and long-dated oil futures pointing to lower prices over time. The risk is that even a partial and temporary closure, combined with Iran's demonstrated ability to disrupt flows with limited resources, sets a precedent for weaponizing strategic choke points. That could justify a structurally higher risk premium across key shipping lanes and encourage firms and governments to build redundant routes and inventories, raising average costs for global trade. From a practical standpoint, the key indicators to monitor are tanker flows through Hormuz, shipping and insurance costs, fertilizer and packaging prices, and corporate commentary on freight and input costs across upcoming earnings season. Together with the energy and AI dynamics we discussed earlier, these supply chain signals will help determine whether the current environment remains a soft but slowing landing or tips towards something closer to a stagflationary shock as we move through the year. To sum up, a fragile ceasefire and a still-choked Strait of Hormuz are keeping an oil risk premium embedded in markets, limiting equity upside, and complicating the rate path as central banks weigh persistent energy-driven inflation. At the same time, the AI Capex boom is very much alive, but markets are demanding clearer evidence of sustainable cash flows and real productivity gains, creating large dispersion between perceived winners and laggards. Finally, supply chain disruptions in energy, shipping, and fertilizers are broadening the cost shock beyond crude, with potential second-round effects on goods and food prices that will matter for both growth and inflation trajectories. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.